This is one of the most undervalued stocks right now, has such good prospects and it's just such a good bargain. Wonder which one it is? Stick around and find out.
Alright, let's get into it. I'm not gonna lie, this stock is boring, plain, but it's been doing great recently. The name? Knight-Swift Transportation. The company is the largest truckload carrier in the US and it just released its quarterly earnings last week. So, why do I think it's great? And that's a really good question. First of all, not only is it a big player in the industry, it is also one of the most undervalued ones. Its price to earnings ratio is just 14.95 compared to its competitors. Old Dominion Freight Line, or ODFL, has a PE ratio of almost 40. JB Hunt Transport Services, or JBHT, has a PE ratio of 33.06. Landstar System, or LSTR, has a PE ratio of 25.58. And Saya has a PE ratio of 46.02. Finally, Werner Enterprises has a PE ratio of 17.65. So, as you can see, its PE ratio is quite low, but the PE ratio alone is not a good enough metric to gauge whether or not a company is good. Out of its competitors, only one has a higher net profit margin, and that is Old Dominion Freight Line. So, we can see that KNX, or Knight-Swift Transportation, is able to generate a better net profit margin than most of its competitors, which is a good sign. Then, KNX has a low debt to equity ratio, although that seems to be normal for the business. And from its competitors, only JBHT has a debt to equity ratio of over 70%, and theirs stands at roughly 50%. But there are other positive signs for the company. For example, KNX has been buying back shares, and in the last 4 years, it has reduced its float by roughly 7%. Essentially, if you had owned 1% of the company 4 years ago, now you'd own 1.07 or 1.08% without having to buy any extra shares. And that is a good indicator. It means that the company is doing well enough to be able to afford returning money to the shareholders. And by repurchasing shares, the company also boosts its EPS, or its earnings per share. And this is an important metric because analysts follow it very closely. By boosting its EPS, the company makes itself more attractive to investors, and they become more likely to buy it, meaning that it is more likely to appreciate and go up in price, which is perfect for existing shareholders. Like me! Then, going on, KNX has beaten analyst estimates for 4 consecutive quarters. It has beaten revenue estimates, it has raised dividends, it has raised the expected earnings guidance, but analysts are still not excited about the stock. And now, I want to point out that analysts are typically short-term focused, they look for massive growth, especially in the next quarter, and that is simply not something that KNX can offer. Instead, it is a steady company with a historical earnings growth of roughly 20%, although I don't think this will continue. Instead, I think an earnings growth estimate of around 10% is more reasonable going forward. Now, KNX's price to earnings growth ratio, or PEG ratio, is roughly 1, which is very low compared to its competitors. This is value investing 101, this is what we're about. We ignore what the crowd is doing and we just look for value where they have missed it. Ideally, this means that you get best stocks, but you can never be too certain. But right now, value stocks like KNX are not as overvalued as the rest of the market. They've been doing okay in the last 12 to 24 months, but they still have a long way to go. And the market conditions are increasingly making investors rotate to value stocks, which is another reason why I think KNX is a perfect buy right now. But wait, there's more. Let's look at the real earnings yield relative to its competitors. And to start off with, KNX has a rough earnings yield of 6.7%, which is way higher than the earnings yield of its competitors. But if we additionally adjust it for inflation, which currently stands at 2.6% year on year, we get roughly 4.1% earnings yield, which is okay. But let's compare it to that of its competitors. ODFL, or Old Dominion Freight Line, have a real earnings yield of roughly 0.1% negative. Then JBHT have a real earnings yield of 0.4%, which is almost 10 times less than the real earnings yield of KNX. So, you get the picture, right? If inflation continues to go up, I think that KNX will just become an increasingly attractive investment. Continuing, I think that if interests go up, KNX will also do well because its price evaluation is relatively low as we just saw, and the net present value of the company won't be affected as much. It also has a really low debt, so it won't suffer as much from increased interest payments. And usually at this point I'll take a look at the industry as a whole, but to be fair, I don't even care how the industry is doing. I mean, the company is enough of a good deal by itself. But, having said that, there is still some positive outlook for the industry, given the reopening of the economy and the economic growth in the US. Okay, these are all of the good things about KNX, but let's be honest, the analysis is not over until we can find something bad about the company. No company is perfect, right? So we need to find its flaws. And personally, there are 3 things that I don't like about this company. It's paying dividend despite it having low cash reserves. And I think that this is just not a great decision for the management to make. If you have low cash reserves, it's better to focus on strengthening the balance sheet instead of paying out that cash as dividends to shareholders. And it doesn't even pay that big of a dividend, so I'm not really sure what they're playing at. We can see that 2 of its competitors have a much better cash reserve. Personally, I'd prefer it if they just focused more on share repurchases or simply keeping the cash in the balance sheet. But, to be fair, the company doesn't really need that big of a cash reserve because it has a positive working capital and low debt. But at the same time, it would be good to know that they're able to weather a storm if there is one. The second thing that I don't like about the stock is the fact that there has been recent insider selling by some of the chairmen before earnings releases, and that is always taken negatively by investors. I personally don't think it spells anything bad for the company, because the sales were really small, but at the same time, insider selling is usually a bad sign, and whether you want to pay a lot of attention to this or not, it's up to you. Again, personally, I don't think it makes that big of a difference, but it's something to watch. And finally, it just doesn't feel like KNX has that big of a moat around it. The industry is hard to get in, so I guess they're protected from outside players because obviously to start a trucking company, you need to buy trucks, right? So there is a big capital requirement, which is a good barrier to entry. But if we look at its other competitors, I'm not sure whether KNX has a very resistant brand, whether it has a resistant competitive advantage or anything else going for it. But I mean, we do see that it's been doing well over the last several years, so if nothing changes, I think they'll still do well. Okay, so we've taken a look at the company, both the good and the bad. Overall, when I look at KNX, I think that the downsides are relatively small compared to the upside. So, why buy the stock right now? Well, there are 2 good reasons. First of all, despite all the good news last week, it dipped 4%, which gives you a perfect entry point. Personally, I bought KNX with roughly 2–2.5% of my portfolio, and I'm looking for more opportunities to add. I think getting it up to roughly 4% of it will be a good idea. And also, as I mentioned earlier, value stocks are kind of having a revival right now, so I think this year value stocks will be doing quite well, and I think that KNX is a perfect example for a good value stock. Alright everyone, this has been my 2 cents on Knight-Swift transportation. Let me know what you think in the comments below. If you think that you've learned something from this video, like, subscribe, and share it with your friends. Thanks for watching, and I'll see you in the next video.